Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be going over the topic of a Roth IRA versus a taxable account. I had a viewer and subscriber leave me a comment saying, hey, I am 19 years old. I want to start investing in a Roth IRA or a regular taxable account. I want to mainly invest for dividends, but I feel like I may want to be able to tap into those dividends well before I'm 59 and a half. And if you know the Roth IRA, in order to get the maximum effect, you have to leave your contributions, to take advantage of the tax-free benefits, you have to hit it 59 and a half. So he asked for my opinion. So this video is going to be going towards that, the Roth IRA versus the taxable account. And a lot of people go back and forth on this topic. So of course, I wanted to create a video on this. So taxable account versus a Roth IRA. First, our scenario. We are 18 years old. We have up to $5,500 per year to contribute towards our retirement. We may retire at 45, 50, 60. Who really knows? We're pretty young, but we have a goal in mind. We want to retire. So what is our best option? A taxable account or a Roth IRA? Well, let's go ahead and cover some of the taxable account benefits. Number one, you're unrestricted. You can deposit, you can withdraw your money at any time for any purpose without having to pay income tax or penalty at that time. So if you invest in an IRA or a Roth IRA and you make deposits and you withdraw deposits and the capital gains, you're going to get hit with a 10% penalty, plus you're going to have to pay income tax on those IRA because that is pre-tax money going in and the Roth IRA is post-tax money going in. But you're unrestricted on a taxable account if you set up an account over on Robinhood, M1 Finance, Merrill Edge, Vanguard, Fidelity. They don't have any sort of minimum. You can deposit. Some brokers out there give you actual stock when you sign up for them, and others, you put in $100, you can do that. You can begin investing. If you want to start with 50,000, 100,000, you have $1,000,000 you just inherited. There's no restrictions. You can go ahead and deposit it. There's no minimum requirements, which we already sort of covered, to min and max. So we already sort of covered that. You can start investing with as little as zero over on Robinhood. You sign up through a referral link. They give you a free stock. You don't even have to have your own money in the game. You can still have that emotional effect as a brand new investor looking at your investments, or you can go ahead and start with much more. So you do end up paying taxes based on how long you've held your investments. If you've held a stock for less than 366 days, you will need to pay the short-term capital gains. Otherwise, if you've held it for over a year, 366 days, then you get that long-term tax rate. So depending on what your tax bracket is, if you fall into the 22% tax bracket for 2018, then you'll actually end up paying a 15% tax bracket on your long-term gains. But if you fall into that 12% tax bracket, you'll pay 0% on your long-term capital gains and dividends, somewhere along those lines. Disclaimer, I'm not any sort of financial advisor or tax professional, but always talk with your tax advisor on these questions. So Step Up, they have a program called the Step Up. If you pass away and you have accounts, stocks sitting within your taxable account, there's a Step Up program where here's your beneficiaries. If they end up selling those investments, they will get it taxed as if you had bought them at the price the day you died. So today, Apple is worth $217 and something like that, and I pass away, and it goes to my child, and he decides he's going to go ahead and sell off the stock. My wife needs the money at the time. She's going to go ahead and sell off the stock. Well, instead of paying capital gains at where I bought Apple, say at 160, she'll only get taxed on the capital gains from that point at $217. Tax loss harvesting, you can actually offset up to $3,000 of your ordinary income with investment losses per year. So if you do horrible investing in stocks such as Sears, General Electric, some other ones that have tanked out there. Say you bought a bunch of these weed stocks, growth stocks at their peak, AMD, Canopy Growth, when they were all over the media getting blasted, and then they fell by 20, 30%. Well, you can offset some of your losses by up to $3,000 per year. And I believe it rolls over maybe 1 or 2 years. You can also decide when to withdraw. So if you've hit 60 years old, there is a time, I know in the IRA, you have to begin withdrawing in the IRA at 70 and a half, somewhere in that range. But as a taxable account, you can actually leave your money in there. If you see that you have to withdraw money out of your IRA and it's going to be bumping you up into a higher tax bracket, say normally you're in that 15% tax bracket, 12% tax bracket, which means that you're going to be taxed at a much lower bracket. But if you're having to withdraw $10,000 or $15,000 automatically out of your IRA because they're forcing you, you can go ahead and hold off from pulling money out of your taxable account, lowering you into that tax bracket instead of bumping you up into that 25% tax bracket where your dividends will then get taxed at 15% instead of 0%. So you can actually just kind of decide there. There's a bunch of those are the main benefits of the taxable account. You will be basically paying taxes every single year depending on how long you've held the investment. If you don't sell the stock, then you don't pay taxes that year because you never sold it. But if you earn dividends from that stock, and depending on your tax bracket, you will either pay 0% or a 15% taxes on your dividends. The Roth IRA benefits. It becomes, number one, it becomes 100% tax-free withdrawals at retirement. So once you hit retirement at 59 and a half, and you've had the Roth IRA account open for at least 5 years, all your capital gains, your dividends, your interest, your MLP distributions, capital gain distributions, that all becomes 100% tax-free. Tax-free, also during that whole time that you've been invested in the Roth IRA, all the capital gains, all those dividends, all the interest that's being paid out to you and it's being reinvested, it's basically built up much faster. It's tax-free investment growth. So if you get paid dividends, you're not having to pay taxes on those dividends per year. You're not having to pay taxes if you decide to take a little bit, the edge off Apple. Apple shut up 40% of your portfolio. You sell off a little bit of Apple. You don't have to worry about paying capital gains on it. You can move Apple, sell off some of your positions to kind of move your money into a less volatile stock or a company that recently took a huge dip. You can go ahead and do that. Don't have to worry about paying taxes. That money will just stay within the account, building up for you until you hit that age of 15 and a half, where you'll be able to take advantage of the full capital gains dividends being reinvested in your portfolio. Compounding effect, much better there. Number three, there's no requirements on distributions such as an IRA. The taxable account doesn't have a requirement, but if you invest in an IRA, then there is a age at 70 and a half where you do have to begin taking withdrawals. And also at 70 and a half, you can no longer deposit towards your IRA, whereas a Roth IRA, you can continue to deposit so long as you're making some sort of income. The Roth IRA, if it's been open at least 5 years and you kind of croak it, you die, it becomes tax-free to your beneficiary. So say over the next 5 years, I put in $5,500. That's $27,000 after 5 years. And I kind of, I kick the bucket. My beneficiary, my wife, my child, they'll be able to take advantage of all the capital gains, the dividends within that portfolio, 100% tax-free after 5 years. Number five, you can withdraw your principal contributions at any time because you've already funded it with after-tax dollars. So Roth IRA, you get taxed on your money, your W-2 money, you get that income going into your bank account, you move that money into your Roth IRA, that's already taxed. You don't have to worry about, if you do withdraw your contributions, you can do it at any time. You're not going to get penalized on it, such as you would on a IRA. So if you deposit it, over 5 years, you deposit $27,000, you decide, hey, I'm going to go ahead and put this towards a down payment on a home. You can withdraw those contributions at any time because that's already after tax money going in. And number six, you can actually use the funds penalty free towards a higher education. So if you want to use that money towards certificates, licensing, or college, you can do so. Make sure to check with your advisor to see if it actually worked towards that program, but you could do it tax free. I'm not sure if you could do it towards your children, but that's something to kind of figure out there. I know you can definitely use it for yourself. So In this scenario, going back to our scenario, this individual, we'll say, was 18 years old. The Roth IRA gets the full benefits, being 100% tax-free at the age of 15 and a half, just kind of bumping it up to 60. That is 42 years of investing. The annual rate of return currently, we'll say 7 to 10%, 3% inflation. We'll just say 7% is our annual rate of return. We're going to be contributing for 42 years from the age of 18 to 60. We're also planning to kind of kick the bucket at 90. Average lifespan of a human is 87, 90. So we'll say that we're going to be saving up and investing at 60 and then have 30 years of withdrawal after we've decided to take advantage of a Roth IRA. Our current existing balance at the age of 18 is zero, and we're going to be making $5,500 every year in contributions. These contributions are going to be frequently every year. And once we retire, we're going to be withdrawing our money monthly because we want to be able to use that money. January, we pull out our money, we use it towards January. February, we pull out our money, we use it towards February, and so on. Our current tax brackets during these contributions, I just use me for the scenario. I sit at a 22% tax bracket going into 2018. In retirement, I'm going to go ahead and say that we don't really know. We can't plan for taxes in the future. Who knows what will happen with taxes? But I went ahead and just continue to keep it at 22% because in retirement, I want to be able to live the same lifestyle that I'm currently living or a little bit more. And I'm aiming for 22% right now. It could be higher. Tax brackets in the future, we could go to a whole different kind of society where we're getting taxed at 40%, 50%. Who really knows? So I just went ahead and put 22% there. So here is our results. Oh, here's your tax brackets. Depending on how much income you currently make or your future, are you going to be married in the future? Are you going to be single? So here, if you're in the 22% tax bracket and you're married, you're making between $77,000 and $165,000. If you're married, you're going to get in that bracket if you make more than 38 to 82. And if you are single, which is over here, your tax brackets as well. So those are just sort of taxes. You can write it down in your head or on a piece of paper. Okay, so here are our results. In a taxable account, after you've been withdrawing for 42 years from the age of 18, depositing $5,500 every single year, at the age of 60, when you decide to, because you want to take advantage of having a taxable account, you're going to have $884,471.77. Your monthly withdrawal, because you're going to get taxed on this money, it's going to be $4,926.87 every single month. And after 90 years, from your total withdrawals, taking out taxes, from your start point till your end point at the age of 90, your total portfolio would have actually grown to about $1.7 million. Now, if you invested in an IRA, that's the tax deferred account, you actually write off some of your taxes. You don't have to pay taxes on the money going in. You're still depositing that $5,500 per year. Your balance at 60 is $1.3 million. That's going to leave you with around $6,891.15 of monthly money going to you every single month at the age of 60. Your portfolio, after those 90 years, when you croak the bucket at 90, your total withdrawals from your portfolio would be $2.4 million. That's after taxes, because you'd be paying those 22% taxes on that money coming out. And if you had invested in a tax-free account, a Roth IRA, a Roth 401k, you've been depositing $5,500 per year at the age of 60, you'd be at that $1.3 million area, same as the IRA, only your monthly income would be $8,834.81. That's a difference of $2,000 just because you decided to, put in after tax money now versus trying to defer some of your taxes. Who knows what tax brackets will be? This is in the 22% tax bracket. If you think you're going to be in a much higher tax bracket in the future, then this is actually going to be much less. I don't plan on staying in a 22% tax bracket. I plan on going and growing my income over the next years. So here, your total withdrawal after you've been investing up until 60 and you've been making withdrawals all the way until 90 is $3.1 million. So that's a huge difference between an IRA and a Roth IRA, and just about double a taxable account. So you can see a huge difference there in your monthly withdrawals with a taxable account and a tax-free account. Pretty big difference there. Now say we want to go ahead, whoops, I went the wrong way. Let's go ahead and say that we're going to retire at 45. We've done a really good job of investing between the age of 18 and 45. We bought some real estate along the way. We've had extra income. We bought real estate. We don't really need our contributions to wait until the age of 60. So we're going to go ahead and decide to retire at 45. From the age of 18 till 45, that's 27 years of investing. In a Roth IRA, you're putting away $5,500 per year. By 27 years, you'd have deposited $148,500 of your own contributions. That's depositing $5,500 per year for 27 years. Your total balance at the age of 45 is $438,337.29. $148,000 of it is your contributions, which remember, the Roth IRA can withdraw their contributions at any time, penalty free, and no taxes. So years until the age of 60 to take advantage of the Roth IRA, the extra remaining money in the account. That's 15 years. So we have 15 years. We have to kind of let some of our capital gains, dividends sit in the account, but we have $148,000 of our own money sitting in that account. We divide that by 15. That's the number of years remaining till the age of 60. That's $9,900 for the year. Split it up per year. We divide that by 12. We can actually withdraw $825 per month of our original contributions up into the age of 60. Now, I'm not saying you should do this, but this is an example giving, kind of my opinion. If you have rentals and you actually want to retire, you want to take advantage of the Roth IRA because you don't want to take the full advantage of the whole compounding of it because you have other stuff that offsets you. You may have gotten like a $2 million, $3 million portfolio of real estate. You're pulling $100,000, $200,000 there of cash flow. This is just extra money that you don't really need inside the Roth IRA. You can go ahead and pull $825 per month over the next 15 years of your original contributions. Now, say you want to retire instead at 50, we don't really know when we're going to retire. I'm 33. This individual's 18. I actually want to retire at 45 as well. So here in this example, we're going age 18 to 50. That's 32 years. Inside the Roth IRA, that's $5,500 per year over 32 years. That's $176,000 of our own money going in. $5,500 per year over 32 years. Our estimated balance at that point is $648,633.82 when we hit the age of 50. How many years do we have until we can take the full advantage of the account? That's only 10 years. So we take our original contributions of $176,000 divided by 10 years remaining. That's $17,600 per year that we can withdraw of our original contributions if for whatever reason we needed to. Divide that by 12 to get our monthly rate of $1,466 per month that we can withdraw of our original contributions penalty-free, tax-free, because we've already been tax on that income. So now after you've hit 60, after 10 years of taking advantage of we've pulled out our original $176,000 of our own contributions, but we may still be contributing there. We're not taking it out completely. We're still allowing money to reinvest in these accounts. So by the age of 60, we will then be able to take advantage of the capital gains, the dividends, the interest that was actually made in that account, using our contributions plus our capital gains, from the account. So it would all have compounded during that point. We may still have a balance around, $648,000 to $1 million or $1.3 million in that range. So at that point at 60, we will still be able to withdraw money tax free because that's the whole point of that account. So that is basically all I wanted to go over in this video, is basically kind of covering the taxable account versus the Roth IRA. The whole point that people make and invest in a taxable account is they don't know when they're going to retire. But if you plan on retiring somewhere around 45 or 50, you're still putting in 148,000, 176,000 of your money that you can withdraw at any time without penalty, without having to pay taxes on that. And if you go through this and you can kind of see you can do your own math of how long maybe you want to retire at 35 or 45 or 40 or 50 or 60. And we've already done our 60 scenario. You can see the huge differences here. If you decide, hey, my plans didn't work out, I'm not going to retire at 45, I'm not going to retire at 50. If I just let my money sit there until 60, I'm going to be retiring with $1.3 million. That's going to give me a monthly cash flow of $8,834.81. So that is all I wanted to cover in this video. I hope you guys did like it. If you did like it, give it a thumbs up. If there's any questions, comments, let me know in the comment section below. If there's something I missed or had an error with, let me know in the comment section below. And quick disclaimer, I am not a financial advisor or tax professional. This video is for fun and entertainment. I was asked the question of my opinion between a taxable account and a Roth IRA. I 100% support the Roth IRA as the main account of investment. If that is your current retirement vehicle, the stock market, the Roth IRA is probably your best option to retire either early or late, 100% tax-free. You can see how this will work if you actually decide to retire at 45. You can see if you decide to retire at 50, and the whole advantages of the Roth IRA there. If you end up dying at some point, your beneficiaries will actually get all of your capital gains, dividends, tax-free. So that is it for this video, you guys. I hope you guys did enjoy it. Let me know in the comment section below. If this video did help you in any way, share it with your friends. And thank you for tuning in to the Financial Investor channel. If you are brand new to the channel, hit the subscribe button, hit the thumbs up button. And thank you guys for tuning in. I will see you next time. Bye.